Welcome to Wealthfinity. Are you looking to plan the perfect volatility for your stock portfolio? Volatility can be a double-edged sword in the stock market, but with the right strategies, you can turn it into an opportunity for growth. In this channel, we will provide you with expert insights and tips on how to plan the perfect volatility for your stock investments. From identifying risk factors to creating a comprehensive plan, we will guide you through every step of the way. Join us and discover how to turn volatility into an advantage in your journey to financial success. Stock volatility, a comprehensive guide. Volatility is an inherent part of the stock market and a major concern for investors. It refers to the fluctuations in the price of a stock over a certain period of time, often measured by the standard deviation of its daily returns. High volatility means that a stock's price can fluctuate rapidly and unpredictably, while low volatility implies more stability and predictability. In this comprehensive guide, we will dive into the concept of stock volatility and its various aspects, including its causes, effects, and how to measure it. Causes of stock volatility. There are several factors that can contribute to the volatility of a stock. Some of the most common causes include 1. Economic events. Changes in the economy, such as interest rate hikes or changes in GDP, can have a significant impact on stock prices. 2. Company-specific news. Announcements like earnings reports, mergers and acquisitions, or management changes can impact a company's stock price. 3. Market sentiment. Investors' moods and expectations can influence the direction of the stock market and individual stock prices. 4. Political events. Political events such as elections, policy changes, and international conflicts can also affect the stock market. Effects of stock volatility. The impact of stock volatility can be both positive and negative, depending on the perspective of the investor. High volatility can create opportunities for short-term traders who aim to profit from rapid price swings. But it can also result in significant losses for long-term investors who are looking for stability and consistent returns. Moreover, high volatility can make it more challenging for companies to raise capital and for investors to make informed investment decisions. Measuring stock volatility. There are several metrics used to measure stock volatility, including 1. Beta. A measure of a stock's volatility in relation to the overall market. A beta of 1 indicates that a stock's price moves with the market, while a beta above 1 means that it is more volatile than the market, and a beta below 1 means that it is less volatile. 2. Standard deviation. This measures the deviation of a stock's returns from its mean. A higher standard deviation indicates higher volatility. 3. Average true range, ATR, a technical analysis indicator that measures the average range of a stock's price movements over a specified time period. 4. Implied volatility. A forward-looking measure of volatility, calculated from the price of options contracts for a particular stock. Stock volatility is an important concept for all investors to understand. It can have a significant impact on the stock market and individual stocks, and it can create both opportunities and challenges for investors. By understanding its causes, effects, and measures, investors can make more informed decisions and manage their portfolios more effectively. Volatile stocks can offer substantial returns, but they can also be risky. Trading these types of stocks requires a specific strategy to maximize gains while minimizing risk. Here are the best strategies for trading volatile stocks. 1. Buy and hold strategy. The buy and hold strategy involves purchasing stocks with the intention of holding onto them for the long term. This strategy is best suited for less volatile stocks, but it can also be effective for volatile stocks if done correctly. To succeed with this strategy, it's important to have a strong understanding of the company's financials and to have a long-term perspective on the stock's performance. 2. Dollar cost averaging. Dollar cost averaging is a strategy that involves investing a set amount of money at regular intervals, regardless of the stock's price. This strategy works well for volatile stocks because it helps to average out the price, reducing the impact of market fluctuations. It also allows for the opportunity to purchase more shares when the stock is down, increasing the potential for gains when the stock rises. 3. Hedging. Hedging involves taking measures to reduce the risk of a potential loss. This strategy is particularly useful for volatile stocks as it can help to minimize the impact of market fluctuations. One popular hedging strategy is to purchase options, which give the trader the right, but not the obligation, to buy or sell a stock at a specific price. 4. Trade with stop-loss orders. Stop-loss orders are a type of trade that automatically sells a stock when it reaches a certain price. This strategy is effective for volatile stocks as it helps to limit the potential for loss. When setting stop-loss orders, it's important to consider the stock's average daily trading range and to set the stop-loss at a level that provides enough room for short-term fluctuations while also protecting against larger losses. 5. Stay informed. Staying informed about market trends and news events is crucial when trading volatile stocks. This helps to anticipate market fluctuations and adjust strategies accordingly. It's important to regularly monitor financial news and to follow companies that you are invested in. Trading volatile stocks can be a lucrative opportunity, but it requires a specific strategy to minimize risk. The strategies outlined above can help traders maximize their gains while minimizing risk. It's important to remember that no strategy is foolproof, and that it's important to carefully consider each trade and to stay informed about market trends and news events. In conclusion, planning the perfect volatility of a stock requires a comprehensive understanding of the stock market and the factors that drive stock prices. It involves understanding your investment goals, researching the stock market, monitoring stock prices, and adjusting your portfolio as needed. By following these steps, you can increase your chances of achieving your financial goals and minimize the risk of losing money. Remember, there is no guaranteed method for predicting stock market volatility, so it's important to maintain a diversified portfolio and to monitor your investments regularly.